Hey guys, welcome back. Today we are going to be taking a look at the Great Depression, specifically what caused the Great Depression. And there were a lot of different things going on, so let's go ahead and jump right into it. First thing we have to recognize is that the 1920s were an enormous boom time. Absolutely fantastic for the United States. Business was going well, unemployment was low. There were all sorts of really good and exciting things going on in the United States. However, I think we were distracted by all of the good things that were going on. I think we were distracted by new technology and new idols and all sorts of different things like that. And we started to miss some of the warning signs. There were cracks in the foundation by that point that we just simply didn't see. And so, one of the things that we have to recognize is that much of the rest of the world was already in an economic depression or a deep recession by that point. And so, while that may not have been the cause or one of the primary causes, it was something that we should have been paying attention to a little bit more closely because we are, as much as we wanted to be isolationist at that point, we still have big companies who are selling overseas, and those are important markets. And when they're struggling, when they're not purchasing products, that has an effect here at home. It was also something that was a because of World War One, a lot of the world was in depression, and particularly Europe. But it does have an effect on us, and it was going to be headed here soon. We just didn't know it yet. What we're going to see is that the economy had begun to slow. Whether it was part of that worldwide depression that was happening in Europe that was having an effect, or just a part of a natural business cycle, there are a lot of different reasons why the economy is slowing, but the economy is slowing. It's just that Americans in general failed to recognize it. We continue to live our life, do our business, buy our goods, and all that kind of stuff, largely unaffected by it. We were not going to allow ourselves, either we didn't notice or we weren't going to allow ourselves to be affected too much by it. So the economy has slowed, but one of the major things, and this is true, I think, even today, is we have to take a look at rural America. Farm debts had really begun to creep up. Farmers are going deep into debt. They're using credit to buy mechanized tractors and harvesters and all those sorts of things in order to try to harvest greater amounts of acreage, right? Plant greater amounts of acreage. We're also seeing foreclosure. So the reality is that while the 1920s were a boom time, particularly in urban America, rural America was probably already experiencing some of those Depression era effects well before. In the entire 1920s, it was hard in rural America. So we look at that as one indicator. If rural America is struggling, that may be an indicator of what's to come elsewhere in the not too distant future. We also know that the stock market played a big role in this. There was a lot of speculation, meaning people are putting money into the stock market in areas where they're just kind of making guesses. They're hopeful that this is going to be the next big boom and that it's going to really expand. There was massive, widespread, wild speculation, and it was creating these bubbles where certain parts of the market were fluctuating wildly. We also saw people buying on margin, and buying on margin was a very, very big deal. In fact, hang on, there we go. Buying on margin means that you're buying a stock, but you're only putting 10% of the stock purchase down. That means that when you sell the stock, you owe the other 90%. Well, that kind of works if you believe that the stock is only going to go up. And at this point, people are looking at the stock market and everybody's getting in. Everybody wants a part of this because it looks like over the long term, stocks only increase in price. There may be minor fluctuation, there may be some slight downturns, but we really looked at the fact that long term, it was really only going to go up. And so people were borrowing money to put into the stock market because they felt certain they could get it back out when they finally did sell their stocks. Then they could pay that 90% back and still have earned a significant profit. This is a dangerous game to play, and it's going to play a big. It's going to be a big factor when we look at the stock market crash. All the speculation, all the buying on margin, all the consumer confidence suddenly just evaporates. It disappears, and people begin to sell off. Well, when you've got more people selling who are buying, stock prices plummet, and it's scary. And then it causes more people to want to sell their stock because they're afraid they're not going to get their money back out of it. Well, the stock market just plummets day after day after day, week after week. in the very last quarter of 2000, or excuse me, of 1929. Right, October of 1929 is when this thing really hits the fan. So, stock market plays a big role in that, as well as the banking industry. We had a lot of banks that were weak. We had a lot of banks that had very little federal oversight. They were using bad lending practices. And so, because of that, the banks were involved in speculation as well. They were taking money as deposits and then making bad loans, making bad investments because, like everybody else, they thought the stock market and certain commodities and whatnot could only really go up. Well, it turns out that's not the case, right? And what we'll see is that they're going to lose a lot of money and not be able to cover all their deposits. So you had bank runs, and you had that's basically where people run to the bank to try to withdraw their money. But when so many people do that, the bank can't cover those costs, and then they have to close down. So if your money was in the bank, that bank just went out of business, and it took your money with it. Very dangerous, very difficult time for a lot of people. And if the banks are going down and the stock market is going down and the economy has slowed, all these different things play a significant role. We also are going to see, now this, I don't know that it was a cause, but it was a symptom of the time, and that is personal spending habits had changed. For all of American history, you didn't make purchases that you couldn't afford. You didn't go into debt. You might have gone into debt in order to purchase a farm, purchase a home, but you didn't have what we would consider consumer debt for things like appliances and furniture and clothing and those sorts of things. Well, in the 1920s, we saw consumer debt really explode. People are doing installment buying. They're buying cars in installments, buy now, pay later, layaway, these sorts of things. And the reason for that is because we want to make sure that we can maintain that middle class lifestyle. We want the latest and the greatest. We're trying to keep up with the Joneses. And as a result, when the stock market does go down and the depression hits, people were not in a good place, not in a good position to really handle that because they allowed their spending to get out of control, and now they had no savings. They were kind of leveraged up to their eyeballs. What we will see here is, and I'm going to zoom in on this because I think this is a pretty good deal here, that as international trade falls, a global drop in business leads to a worldwide depression. And so what we see is that U.S. profits begin to plummet, and so U.S. investors have little or no money to invest abroad. European nations then can't pay off their war debts, and European production plummets. Europeans then can't afford U.S. goods, and the cycle kind of repeats itself. It's the opposite of that boom cycle that we saw in the 1920s. It's starting to spiral out of control. Now, the reality here is the U.S. economy had been very strong. It had been doing very well. And there wasn't one cause. Think of it as a kind of a platform that's supported by a lot of different columns. If you were to take out one or two of those columns, but there's still dozens, well, okay, it's a little less stable, it's a little less strong, but it's not going to collapse. Well, we saw the consumer credit column get taken out. We saw the stock market column get taken out. We saw consumer confidence get taken out. Banks collapse. So every single one of these steps is taking out another column that creates the foundation of our economy. If any one of these things had happened, the American economy was probably strong enough that it would have withstood. But when you had so many in a short span of time that really get weakened or undermine or collapse altogether, the weight of the American economy becomes too much on the remaining columns, and it really just kind of collapses. And so ultimately, that's what happens. Now, there are a lot of even smaller causes and kind of fractures in the foundation, but those are the big ones. It's the stock market, it's the run on banks, it's consumer credit, and so forth. So really appreciate you guys watching. Make sure that you subscribe, like the video, and leave me any comments. I'd love to hear from you. I know that there's some that I missed, but those were the big ones. Thanks for watching, guys.